and welcome to TBR's webcast, Following the Sun in 2012, Insights from TBR's Global Delivery Market Landscape Report. My name is Allison Crawford, and I'll be your host for today's session. The focus is to provide business research to accelerate our customers' success, and the information we'll be covering today comes directly from our Global Offshore Delivery Market Landscape Report. This detailed report includes information like regional headcounts, revenue per employee, attrition and utilization metrics, and deep dive vendor profiles. This information will be invaluable to any firm with plans to expand their global footprint or compete more effectively in the global delivery market. We're going to present some of our findings today and get your feedback on our information. Before I hand this over to Liz and Ramunis, there are a few action items I'd like to cover with you. First, we will be recording today's session and posting it to the TBR YouTube channel. We invite you to visit the channel to watch this presentation or any of the others we have posted. We'd like to hear your opinions and thoughts on the materials we're presenting. Please send any questions or comments to the Q function or the chat function. Liz and Ramunis will address them at the end of the presentation. Third, send out the slides to everyone registered for today's webcast within 24 hours of the conclusion of the webinar. Now let me introduce Senior Analysts Liz Leonard and Ramunis Farkas on the Professional Services team here at TBR. Liz has been covering the professional services market for over 10 years and runs the Management Consulting Research Program here at TBR. Her insight into both the offshore market and management consulting market give her an amazing insight into how vendors are competing globally. Ramunis has 30 years of experience in technology analysis, business marketing research, and forecasting experience, and has primary research responsibility for Deloitte, Bain, Cisco, Unisys, and HP Services. Now, let me hand this over to Liz and Ramunis.
Thanks, Allison. Onshore, nearshore, shore, right shore, or really any shore. These are terms that describe IT service vendors' resource management strategies and have increasingly turned to the east, to India, the Philippines, China, and other offshore locations to capitalize on those populations of lower-cost, educated hires to extend their service delivery opportunities, have invested in resources for global service delivery to not capture new market growth, to leverage access to lower-cost resources and locations, to increase margin while adding to the top line. Key studies leading IT service vendors' investments to deliver insights into what types of vendors are doing in which areas or offerings or services, in which regions, how local leverage or onshore access is contributing to the expansion of profits. Liz Leonard, and I'm a Senior Analyst with Technology Business Research's Professional Services Practice, and I'm in development of TBR's Global Delivery Research Program. Today, we'll highlight findings from our fourth quarter 2011 research, specifically to look at areas of growth among IT service providers regarding their global delivery. Namely, the segments of providers, the focal service lines, the resource composition, investments aimed at efficiency. And help me field some of your great questions at the end. Let's get started. Our answers questions in key areas to help determine vendors' resource management success and reveal which areas they're expanding or investing to grow. Further, TBR Global Delivery Landscape reveals how the offshore strategy, or lower cost resource strategy more accurately, playing into opportunities among IT vendors. And the strong focus of our research reveals areas of efficiency, really understand what strategies are being leveraged to increase productivity through tools, automation, and realization, aim to decouple revenue from headcount. The service vendor team. Total in our research analyzed for its low-cost leverage based on service line, region, and resource type. The services we discuss and evaluate include applications outsourcing, or AO, information technology outsourcing, or ITO, process outsourcing, or BPO, and consulting and systems integration, or CNSI. Regional TBR analysis includes the Americas, EMEA, and APAC. Additionally, our research and our report includes country-level headcount in profiles as TBR estimates and where that information is available. Key services that we evaluate are included here with the 12 logos you see on the slide. Each of the vendors owes a portion of their success to the utilization and optimization of lower-cost resources in combination with nearshore or onshore resources. All service providers' delivery investments are changing, review insights into growth service lines, how they leverage resources to balance opportunity, and how operational improvements aim at profitability. The vendors included in this list here, it's not really a static list, but these are the 12 that we evaluated over the past 3 iterations of this research. And as clients come on board and join our research, they have an opportunity to add logos they would like to see included. We're open to suggestion. The study also includes executive summary, which compares measurable outcomes, along with 12 in-depth vendor profiles that include dashboards and other cool metrics for you to evaluate. Additionally, the analyst knowledge transfer time. So, to better understand the market overall, TBR views segments of global delivery market. Are the firms, the vendors that have more similar attributes and more commonly come in direct competition with one another. While each vendor competes through its own unique and particular assets, TBR has identified common benefits and approaches within these 3 segments. System integrators that have support and maintenance capabilities. And in the list we include IBM Global Services, Dell Services, and HP Services. We really let them capitalize on cross-selling opportunities and their on-location presence. 3 vendors is evolving their methods to move up the stack, their value consulting. If we look right here, the pure SIs, or systems integrators, we include Accenture, Capgemini, CSC, and Xerox. These sort of more mature in the business here and have aligned to verticals, offerings to verticals, and more sophisticated IP and assets to differentiate how they deliver their own operations. These vendors have a more mature delivery and are really increasing sophistication around efficiencies. And they take advantage of cost savings opportunities that are really improving profit margins. On the list, we have the 5 Indian vendors, which we've Cognizant, TCS, HCLT, Infosys, and Wipro. Now, these Indian vendors are rapidly growing their staff, as you'll see our research indicates. And they're focused on expanding the breadth of their offerings to their global footprint with headcount size. And the headcount is really offshore. That's the most interesting part of our story here today. So we've heard a lot of these firms talk about how they're decoupling and aim to decouple revenue from headcount. However, despite a rather economic year, in the past year we've seen aggregate growth of headcount that's pretty healthy. As you see slide here in this graph, our total average headcount growth is 22%, with 16.3% headcount growth in lower cost resources. That puts lower cost resources at 1,143,600. Really an incredible number for a slower year. Offshore headcount, however, grew by almost 6%. What we're seeing here is a really interesting time of then talking about decoupling headcount from revenue, but really they are investing. It's revealed to us that more and more finding account to service and increase your service capability really continues to be the mantra for most of these companies. Also see is more of any shore approach. So regardless of if it's offshore, if it's near shore, the idea being that it's low cost. If there's low cost resources that can augment and complement the high cost resources. So we'll get to that as well. We do have success decoupling headcount from revenue truly varies by service line and the vendor. Looking at our 12 vendors here. The graph on this slide in the top portion is which indicates the proportion onshore headcount. And the blue is the lower cost headcount. So if you look overall, you understand the size that have support and maintenance have largest staff and have grown significantly more than the size in the past year anyway. The data is really comparing 4Q11 to 4Q10. And substantial growth on the far right of this graph, the Indian vendors. So we have a healthy commitment out of these organizations to continue to grow and expand their presence globally. Is really lowest among the pure SIs, with Accenture being a real distinct exception among its peers. We see the SIs aiming to do more with what they have. So, and what is driving these growth rates? Let's market drivers include the high value service offerings that all of these vendors are aiming to deliver. Composition or balance of type, investments in efficiencies, which the vendors indicate is really paramount to their profitability. Fourth quarter global study indicates there's a market of IT vendors evolving methods to garner profits and revenues. And vast global breadth industry is increasing in tandem with specialization in key industries and key growth areas. And the areas that we really see drive demand are cloud, social media, BI analytics, and mobility. Those topics we all talk about every day. Let's dive into these higher value service offerings. Value offerings are in the consulting and systems integration service area. And they're based, the growth here is based on asset use. They're really improving revenue per employee. So looking at here indicates growth in revenue per employee for each companies, and the color code highlights each segment. SI really remains highly onshore delivered, with reason and revenues strongly tied to headcount. Pro, which is closely followed by Capgemini and TCS, really accelerated decoupling linear growth from revenues in 2011 in value offerings based on asset use. They're creating these assets and delivering them internally through their offshore locations and their lower cost resources. On this graph, really outstanding to notice the firms themselves, which grew their headcount in the CNSI area by more than 19% in 1 year. They are rapidly growing their offshore, then growing their lower cost resources. Really, the story here is Indian vendors are seeing higher profits, higher revenue per employee, which is going to underpin their commitment to develop onshore service capabilities and leverage those key relationships they've established for high-value consulting opportunities. This is an interesting story for all the MNCs and more traditional SI providers to pay attention to. So, what are the service capabilities in these higher end? What's the higher value? Well, I mentioned before, IT vendors are focused on the business issues, a focus of their enterprise clients, and analytics and business intelligence, social media, cloud particularly, and mobility. The IT vendors are honing their messages around business outcomes derived from these high-priority IT-enabled offerings. There's an increase in specialization around sectors, oracles, and BI analytics, as well as a business function approach. Offshore, lower-cost support resources enables consistent platforms onshore client-facing resources to utilize. Cloud is a large area from which demand really stems, and expanding the breadth of their cloud coverage, be it end-to-end solutions or adding platform as a service, or again, refining vertical-aligned applications for cloud, developing their specialization by vertical. Also, cloud offers tech transformation opportunities, and enterprise clients are taking advantage of these transformations to build out and expand their global footprint and increase profitability. That strong alignment of service delivery to the business issues, significant opportunities for vendors in the near term. And therefore, it's not a story of the breadth of global capability and capacity, but also the depth and specialization that's going to drive growing demand and success for the IT vendors. So, the resource composition. There's a story here in that the IT vendors, within this recent generation of research, are ever more balanced, seeking low-cost leverage and lower-cost resources to reduce costs, but to understand where the opportunities lie. So, being a balance with the onshore, higher-cost resources, client-facing opportunities. Again, priority business issues around cloud, mobility, and analytics really do drive demand for higher value on onshore presence. If you look at the graph here on the upper right, please notice in the right corner of growth, we're looking at more than 33% growth in onshore headcount because plus the Indian vendors. This is more than twice the headcount growth of size with support and maintenance, and 3 times that of pure size. So I guess all I can say is, you know, the Indians are coming, they're coming onshore, they're coming to the Americas, and they're developing the high-value capabilities in the consulting and system integration. I'll look at the lower chart here. In APAC, year headcount growth was highest in the SIs. So we're seeing this transatlantic growth trend here, where traditional SIs, which, you know, they're seeing the opportunity to develop more low cost, but more on the onshore side as well. In APAC, we've got more than 26% headcount growth in offshore APAC among SIs. Interesting time to see where opportunities lie and how resources are aligning through a balanced approach. And in the geographic distribution, more about not offshore, onshore, nearshore, but really what is the best shore strategy. And TBR believes that best shore strategies are essential for vendors to compete and succeed. This slide look at the headcount by region, and it's really surprised that more than half of the global headcount remains in APAC. In our report, we go into more country-level detail, but India continues to be the dominant location for resources, which is followed by the Philippines and China. The Philippines and China did have decelerated growth, where India continues to grow at a strong pace. However, percent of global headcount has grown and is now almost 27% of global headcount. Low cost as a percent of global headcount in the Americas is now up to more than 6%, which is a 30% growth rate over the prior year. So it no matters where the person is located, but how they're being used to optimally balance and achieve profit margins. It's not a country anymore. The third key area to understand is really investments made towards efficiencies. We've heard more investment in efficient delivery from those pure SI companies who are creating more industrialized approaches and recurring strategies and approaches on a team-based approach to have standardized and automated service delivery, particularly in support of those higher value offerings. Other efficiencies that are taking shape are cloud-based and also communication platforms allow the vendors themselves the ability to transition more effectively. And these transition methods are really driving multi-location team success. Vendors are really balancing low-cost leverage, high-value service mix to increase their emphasis not only on industrialized delivery models, but to focus to support their profitability. So we've seen an increase in these efficiencies and productivity measures, but one of the key areas to really understand productivity is utilization rates. So we understand that have been increased investments, however, there's room for improvement. Vendors are really continuing to invest in headcount as well as delivery efficiencies. But while in headcount, their utilization rates are coming down. There's still room for improvement. There's still got to be a refined optimization between these automated and delivery processes You can see that low-cost utilization was actually down 80 basis points prior year levels. That's continued to grow. Offshore utilization was also slightly down from quarter 10. So vendors are increasingly opportunistic. They're making strong investments. They're developing offerings to align to clients' highest business priorities, meeting their demand levels. Well, they're currently investing to expand their capacity for higher value services, their resource composition to take advantage of the onshore resources by utilizing their offshore resources to support, and they're investing for more efficient delivery and ability. TBR's research now goes into compare analysis in our executive summaries. We also have 12 in-depth vendor profiles. Insights are built around key metrics, which is sample here on this slide that show you how onshore and low-cost headcount as a total composition for each firm, as revenue growth compared to headcount growth, operating margin as it correlates to low-cost leverage. The TBR's third iteration of this research, which allows us to track and trend really interesting points as vendor dashboard. At onshore utilization, low-cost utilization, as well as attrition rates over time, and what's working, what's effective at vendor level. So today we've provided some highlights and glimpses into the content of the fourth quarter Global Services Delivery Study. We've looked into areas of investment to understand where vendors are expanding, and we've looked to the resource composition strategy, or onshore versus lower cost resources. We've understood better how efficiencies and how investments towards efficiencies are impacting productivity. For additional information or any questions, we'd be happy to take any questions from anybody that's here, but we do have contact information for anybody who's interested. And also, we included some slides at the back of this that outline you TBR's taxonomy and definitions of the terms we use in this research, in view of vendors, market segments, service lines, regions, metrics, and time periods that we've covered this.
Liz, and so I'd like to take the time to open up the lines to questions. We've had a few come in. I want to encourage anyone out there that has any questions on what Liz just presented to please send them through at this time. The first question we have is what's growth faster in SIs with support and maintenance compared to pure play SIs?
Ramon, do you want to talk about this one? Or?
You know, we've got these segments that we created in the marketplace, and traditional SIs, you know, which had support and maintenance, have a legacy infrastructure in place, and they have utilized, you know, offshore and low-cost resources to deliver their support and maintenance, and experience in the marketplace, and subsequently that's driving their ability to expand now in a much more broader perspective from a services standpoint, in terms of looking overall professional services and offering the various services to basically grow their business, and they have the understanding of how to leverage that kind of business.
And I think there's also a slower growth rate taking shape among those pure SIs who more with what they have and invest in those areas of efficiency, trying to leverage what they already own rather than go and acquire more headcount.
I think that in conjunction with that, they're the ones that are really trying to build out their automation and IP understanding and leveraging it so they do not have to grow the headcount as quickly as some of the other players in the marketplace.
Okay, the question we have in might be somewhat outside the scope of the project, but you might have come across things anecdotally. Any sense that H-1B visa pressures are slowing down any companies?
Yeah, it's a little curveball. It's a really specific question, and while we didn't get into that in the study, I think the question around integration and how firms are able to share and manage, resources from other countries. I think we're seeing a lot of these companies invest in establishing locations so that they're having to move as many of their resources from one location to another. They're creating hubs and sort of spokes off the wheel, not only in India but in Latin America and Philippines. We're seeing a lot of more investment into those facilities.
Also, in the United States, where H-1B visas hit most, is the biggest issue. Many of the Indian vendors, especially, have started creating little centers of excellence, as well as leveraging their data centers here in the States, and are basically removing that issue by basically utilizing onshore resources, and subsequently it's becoming less and less a factor from that perspective.
Right. And the Indian vendors are also hiring onshore, so they're keeping their talent local.
The question that's come in is, how do you see the Indian investment onshore playing out? So good segue. Will they take market share from traditional consultants?
It's a really good question, and we think a few things about that. These are faced with opportunities, and these companies have established relationships with their enterprise clients that they're going to capitalize on, and then they are hiring absolutely from those more traditional consulting, management consulting type roles. For them is going to be it's easier for a company to move downstream than it is for companies to move upstream. So they're going to have to prove their value and their ability to deliver on that higher value message. There's going to be a shift in their value proposition and their statements that they're not just low-cost providers. They're going to have to really walk and talk the talk, that they can provide value and clearly their onshore resources will be supportive of that. But those organizations operate culturally is going to be a question that remains to be answered.
Great.
Than some of these traditional MNCs.
Okay. The last question that's come in so far is, with utilization declining, what is happening with the attrition rates?
I'm going to actually get into the presentation here today on that topic. The interesting findings in the study is that we saw almost across the board that attrition rates have been slowly declining. And what we're seeing, and it's apparent from our coverage of the companies as well, is that many of the vendors that are basically building out their resource infrastructure offshore and low cost, trying to make sure they do not lose the employees that they've hired. So putting in programs to retain their employees, making sure that it's worthwhile for them to stay on with the organization, and making little benefits and various offerings that keep the employees in place, so they do not lose the initiative of building out those low cost resources and having them spirited away by another organization.
Right.
Great. Thanks. The last questions come in. What I'd like now is Ramunis and Liz, and thanks everyone for the questions that you've brought. We've been interaction today, and we look forward to continuing the dialogue. I'm going to wrap up our presentation today with some information regarding the study that Liz and Ramunis just talked about. If you'd like to get access to this report, please either email Liz directly, as the email listed here on the screen, or James McElroy, our Director of Sales. What we'll do is leave the Q&A function open for another few minutes in case anyone has any last-minute questions they'd like to get some information on, or set up another conversation to talk to the analyst directly about this research study. Thanks, everyone, for joining today, and we look forward to the continuing conversation.